All right, Ricky, do you want to get us started?
Yeah, I can see most people, it looks like, have filtered in, so let's get to it. We do have a lot to cover today. So hello, everybody. We would like to welcome you to our last session of this year's Foremost Real Estate Investment Summit, or FREIS. I'm Ricky Dogan, Head of Investor Relations, and I'm watching my weight, so I'm going to pass on the French fries this time. We appreciate you taking the time out of your day again to join us. We have received great feedback on the last two sessions, and we hope that you find today's chat equally as insightful. We have two amazing guests and only 1 hour with them, so I'm going to try and pass it off to Evan as quickly as I can. FREIS is, sorry, a little technical glitch. FREIS is in support of Face the Future Foundation, a truly incredible not-for-profit organization that raises money to fly North America's top head and neck surgeons to the developing world, where they provide life-saving and life-changing surgeries. This charity is so phenomenally efficient and lean that each dollar you donate buys $45 in equivalent healthcare services. If you enjoyed these talks, we encourage you to donate directly to Face the Future. No amount is too small. For the many participants who have already donated, on behalf of Face the Future and Foremost, we cannot thank you enough for your support. To kickstart the fundraising, we approached some of our favorite service providers and supporters. They have all made donations directly to Face the Future and donated without hesitation. We would like to again thank our presenting sponsor, Equitable Bank, as well as Ernst & Young, Bloomberg Sen, Prime Quadrant, Harvey Mandel Barrister and Solicitor, Evans Investment Counsel, and Joshua Chait at Sutton Group Admiral Realty. All right, so Fred Wax joined Trinity Developments as President and CEO in 2015 after previously serving as President and COO of RioCan. During his time there, he was instrumental in growing RioCan from $100 million to $15 billion in assets. Trinity is a mixed-use developer with 14 projects in development in Canada and more than 35 million square feet of real estate developed, including 25 million square feet of retail. Rael Diamond is the President and CEO of Choice Properties REIT. He was serving as the COO of Canadian REIT when it was acquired by Choice in 2018, which made Choice the largest REIT in Canada at the time. Choice's REIT portfolio holds 725 retail, industrial, office, and residential properties with over 65 million square feet of gross leasable area and has a strategic alliance with its principal tenant, Loblaws. We've had a lot of questions from investors and borrowers about the state and future of the retail and condo segments in Toronto, and I don't think that there are two other individuals better suited to give their opinion on the topic. So without further delay, I'm going to welcome Evan, Fred, and Rael. Please note that you may need to click on the screen to change the view so that you can see the panelist's view in full screen, and you may want to select speaker view as well.
Okay, thanks, Ricky. Hi, everyone. I'm really excited for our session today because we're joined by two friends of mine, both who are rock stars at the top of their real estate game. And so Rael and Freddie, thanks for taking the time out of your hectic schedules. I'm really looking forward to this. I think this should be a ton of fun. I usually start these talks with a quote from the most famous doctor I know, which is Dr. Seuss. However, today, instead of a quote, I'm going to give you a fun fact about Dr. Seuss, which I'm sure would resonate with the two of you and hopefully with everybody in the call. He was persistent. In fact, his first book was rejected by 27 publishers, but he didn't give up, which I think is a great life's lesson. And I'm sure today we'll get some life lessons from you guys as well. So let's move on to the show. I want to devote as much time as possible to hearing your views on the market in general. But first, it'd be great if we could introduce you. I know you guys, but for our audience of investors and borrowers, it'd be helpful for them to get to know you because you both have interesting stories. So it won't do justice to your careers to ask you to keep it brief. But do you think you can quickly summarize the path that got you to this point? When you start with Freddie, and then we'll go to Rael.
Okay, just quickly, started in the brokerage business, then went to work for one of the principals of in the shopping center business, actually the first developer in Canada, named First Shopping Centers or First Plazas. They owned 2 assets, one Dixie Mall and one Lawrence Plaza, which anybody who lives in the Greater Toronto area is very familiar with. Anyways, from there I went on to work for a trust company that went Mahula, and then I went to work for a life company that went Mahula. So that means under in my terms. Great experience in terms of learning what to do and what not to do, a very humbling experience. And then I joined what was the council closed-end fund, basically, which was becoming REIT with 8 employees, and went on to help with a great team to make it the largest real estate trust in Canada until Rael took over that position, and went over to Trinity. Trinity was the development partner of choice with REIT. Had a long-term relationship with its principal, John Ruddy, who used to work for another very large developer that owned 87 shopping centers in Ontario and the likes, and basically has transformed Trinity, which is now a company with 50 employees, with basically the majority of its business being mixed use, residential, in particularly the GTA, and even particularly the 416 in Ottawa.
Okay, so we're going to get more into your portfolio in a bit, but so I guess you've now proven at least that they didn't go Mahula because of you, because you've managed to move on.
I hope not, but it was I did get to work for a receiver twice, once for 1 day, once for 2 days. So that was it makes you very, very humble, to be honest with you.
All right, thanks, Brady. So Rael, do you want to tell us briefly how somebody close to my age gets to be the CEO of the largest REIT in Canada?
Yeah, sure. So Fred, firstly, we today own half of Dixie Mall. So you started then, and the piece we own is the better half of the mall. But look, as you can hear, I'm South African, and the reason I say that is because every good South African, what you needed to do is you had to become an accountant. And I always wanted to go into business, didn't know what I wanted to do, but the way in South Africa you went into business is you became an accountant. So I immigrated to Canada right after high school, and I did accounting, and I went to work at Deloitte & Touche. Was really my first full-time job. And I landed up in real estate, not because I wanted to be in real estate. It was really by luck. I was in a financial institutions group, and they wanted someone on the hardest job in the office, which was a real estate company, which, as Fred had pointed out, was going through very difficult times, emerging from bankruptcies, etc., in the late 1990s. And the reason I switched out is because I didn't want to do this. Essentially, was a funeral home. So that's how I landed up in real estate. I was really lucky, and I love real estate because it's very, very intuitive, especially when you think about income-producing properties. It's really cash flow. But from Deloitte, I went to go work at Brookfield, and Brookfield used to hire. Essentially, they used to hire the auditors at that point, and Brookfield was the most phenomenal training ground. Like, essentially, the harder you worked, the more you put up your hand, the more they threw at you. And we spent time in Australia with my wife. We spent time in New York. So it was a phenomenal experience. But at the end of the day, we had a hard time saying, where do we want to live? Do you have to pick a city, or do you pick family? And by being South Africa, most of our family, both my wife's family and my family, had moved to Toronto. So we came back to Canada. I was the CFO of Canadian Real Estate Investment Trust, or CREIT, at that time, which, very well diversified, well-performing REIT when Choice bought us out, call it 2.5 years ago. And really at CREIT, I was on a path to succession. And I think it's just a combination of luck and hard work, Evan, that and the right timing that you land up in good positions.
He's being way too modest. He's being way too modest. Rael is probably one of the most learned. He's just a smart guy, and it's great when something phenomenal happens to people that have the work ethic and are decent and know their business. And anybody who has the pleasure of dealing with Rael knows that. So it's really good when good guys come out on top. And to be again, he's way too modest. You know, he was basically groomed by Steve Johnson to be his successor. And then he had to be picked because there was lots of people clamoring for the job at Choice, and he became the guy. So, you know, way too modest for my particular, one thing I'm not as modest. And it's wonderful to see when really good things happen to good people.
Thank you, Fred. Way too kind.
I agree. By the way, to get Freddie to agree to appear today, I had to get Rael. He said, if Rael's in, then I'm in. So thanks, Rael, and thanks, Freddie. So, okay, one more thing on your backgrounds, and then we'll move on to get some prognostications from you guys. But you were both COOs in your former role. So you were the guys who got stuff done. And so curious how that's helped shape you now in the CEO roles, and what we can learn from that. Either of you guys can go first.
So Fred, let me go first, and then so I was really fortunate because I did both sides. I did the CFO role first, and I'd done the CFO at Brookfield for various of their public entities. And then, you know, I think to be a CEO of an entity, you really have to understand leasing. And Fred is one of the great retail leasing minds. And by being in that CEO seat for, you know, call it 4.5 years or 5 years, you know, really spent a lot of time leasing property management. So I was very fortunate that I got experience both on the financial side of real estate, the investment side of real estate, and in the operations, because I think it's very difficult to, you know, guide an organization unless you understand, you know, how you keep your properties full or how you create value through asset management.
Yeah, thanks for the kind words on the retail leasing. Basically, I had done everything from Dixie Value Mall to Hazelton Lanes in terms of leasing, which completely covers the gamut. And I realized in your 30s, if you basically achieved everything you do in leasing, you have to understand operations, finance, capital, et cetera, et cetera. And in the end, a leasing person is a salesperson. Now, so is I think a CEO is more of a salesperson, by the way, than a COO. A CEO is responsible. At REIT, I had development, leasing, operations, asset management, marketing, and HR all reporting up to me. So everything but basically finance, and sat on investment committee. But the capital market side was Eddie's purview. And basically putting that capital to use was very much my responsibility and helping to put up the numbers. So I think they go hand in hand, but when you make the emerge from COO to CEO, then you have to start to become the face of the organization, unless you sometimes can have a face of the organization like Steve Johnson, who had no face of the organization, who was very quietly putting up the numbers, and nobody put up the numbers like CREIT did. So when they did the merger going to CREIT and Choice had this incredible portfolio. CREIT had a good portfolio, but not the massing, but they took the best elements of CREIT and married them up with Choice. So, you know, I think they go hand in hand.
Okay, thanks. So in terms of themes, what I was hoping we could do, we'll cover the economy and the impact of COVID, but also because I know you guys, I do want to talk a little bit about values and culture. So we'll leave a bit of time for that at the end. I'll give you a nice, easy, slow pitch right up the middle, okay? Interest rates. Where are they going? Would you have an opinion on where they're going to go? Because obviously that will impact real estate.
Go ahead, Rael.
Yeah, look, I think it's tied to the economy, Evan. You know, the economy is obviously under a lot of pressure at the moment. It's very slow. So we have a view internally, and I think will be shared by most people on this call, that interest rates are going to stay low, low for a long period of time. We don't see any big reason that they're going to be pushing up anytime soon.
I concur. I mean, there's absolutely no reason in a volatile world, in this world, post-election is just as volatile or maybe more so. There was a bit of glimmer of hope and interest rates were going to rise 2 days ago because of the COVID vaccine, which may not be the COVID vaccine. So I would not bet on increasing in interest rates at this point in time.
And the other thing I think is the governments have loaned borrowed so much money that they need to keep interest rates low because otherwise they've got a massive interest rate, bill every month. So I think you're going to see low rates globally for a while.
Okay, so then the follow on to that is, and I'm going to hit you with the thesis question after that, is that in the beginning of COVID, everybody was thinking, okay, COVID will last a year, vaccine will come and the whole world will be good, right? And then you hear about the fact that people can get reinfected, the antibodies don't seem to last that long, and so herd immunity might not work. And so do you have an opinion on how long, is COVID a short-term problem or a long-term problem from here?
I keep on using the analogy of the Spanish flu, and where people dealing with family, and you're dealing with immediate family, and you're dealing with co-workers, and you're dealing with industry leaders, and you're dealing with your staff, and you're dealing with your partners. And as I said, I look at this as basically, the Spanish flu ran on for 2 years, and then the decade preceding the Spanish flu was what? The Roaring 20s. I'm an optimist. I think that looking from March till November, the paradigm has changed dramatically because I look at having just coming off being the chair of a foundation for one of the big hospitals. The fact is less hospitalizations, less mortality, greater numbers of people that are getting involved in the pandemic. So I think they're finding ways to manage the illness, manage the deaths, manage the strain on the hospital system, and that to me brings things back to normal. Because I don't understand some restaurants can't be open, but gyms can be open to a certain extent. I don't understand that process, and as a landlord, I'm sure that everybody who's a landlord of any retail space or offices, etc., is trying to figure out what the norm is. I have 100% staff. You guys are talking about 20% staff. Different asset classes are all being affected. I haven't been in a mall since February. I don't know if my wife or kids have been, but all the dynamics have changed dramatically. But I think that we will get through this, and even if it's short term that the vaccine helps, people will continue to want to live. I mean, I feel bad for restaurateurs. I feel terribly bad about my friend Ellis Jacob. I feel, when you hear about great institutions or entrepreneurial people in the retail business that are going under and that are happening more and more, this sustainability is not going to be there forever, and the government can't continually prop up people. So it's very concerning.
Look, I agree with Fred. No one has any crystal ball how long it will last, but like Fred, I'm an optimist, and I never thought we'd be sitting here in November saying this is still going on. But I think if you look forward 2 years, I think things will start, generally returning to, normal. People will be going to hockey games again. People will be going out to restaurants. People will be going to gyms. It may be tough, going for the next 12 months or the next 18 months or maybe the next 24 months, but things will eventually get back to normal.
Okay, so this is a question I posed to Ivan, my business partner. And you've kind of hit the parameters exactly on. So I'd said, if you believe interest rates are going to be low for 5 to 10 years, which is pretty good for real estate, but COVID will be around for at least another 2. How do you allocate capital? Because that'll, number one, it'll create some risks, but it'll also create some great opportunities for people who are willing to deploy money. So if you were sitting on an investment committee, and well, I guess you guys are, and you're thinking about how to allocate capital, if that was your view, what do you do?
Well, I'm in the development business, and the development business, thank God, or sometimes not thank God, takes a long time. Right. So what we're building is 2 years or 3 years out. And if you're building if you believe in the fundamentals, if you believe in the city of Vancouver, or you believe the city of Toronto, or you believe the city of Ottawa, or you believe in Calgary, or whatever, where you decide you're doing business, and you believe that there will be positive immigration again, and that there will be jobs, and the GTA is the third largest metropolis in North America. It's a great place to be putting money in dirt, and now that the city recognizes and the province recognizes that intensification is, we're in a better place than we were 2 years ago. With LPAT, we are back being able to not be controlled by local councillors. We're able to actually city build. We're able to take advantage of what Metrolinx is doing right now. So that gives me huge optimism, and it gives me patience, because going through the system takes that much time anyways. And 2 years ago, you had LPAT. The cost of building was increasing dramatically, but the cost of, the pricing in terms of condo and rental rates were commensurate or outrunning those numbers. Right. So the fundamentals still work pretty well if you're in the residential business. And the other part is having family in the residential business and have building and knowing that business quite well. You're collecting close to 100% of your rents. It's been way better than the commercial, the office, or particularly the retail side of the equation. So I think it depends what sector you're in. Right now, the sweetest sector is industrial. Industrial rents are going to where retail rents are, and you're not building complicated developments. They don't take as long. You have surface parking, and it seems that you need lots of places for parking because everything's going to be delivered in the next while, and I think that paradigm's not going to change so quickly.
Look, I think Fred touched on a few themes which are important. So, firstly, he used the word long-term, and real estate's best suited, obviously, for long-term capital, long-term patient capital, especially the portfolio that we own, which is largely income producing, and we spoke previously about COVID being a shorter-term problem. So, as Fred said, he's developing for the long term, and he's thinking past COVID. So if you have long-term patient capital, and then you focus, he used the word quality dirt. If you focused on, good quality assets, they will long-term always outperform, weaker assets. They'll attract better quality tenants. They'll attract higher rents. If they're well located, as Fred said, they can also be then converted to an alternative use in the future. If for some reason, whatever the initial intended use, change, preferences change, or so I think if you focus on long term and you focus on quality, you may have short term fluctuations, but we believe that it's still a great investment, and you can do exceptionally well.
I agree with everything, saving except for one part. When we all started in the business, probably the greatest asset we'd want to own is a Yorkdale. And on a cash flow basis today, I can tell you I'd rather be sitting on choice stock or a REIT or units than I would owning a Yorkdale. You have to also look at, to get you through these crazy times, where is the money going? Well, we know one thing for sure. They're going to food grocery stores and to drugstores. And because I get asked this all the time, where would you put your money? And I always say I'd put it in the banks and choice. And I put it in choice because as a barometer as to looking at good times, bad times, people have to live, but they have to eat, and an aging population needs their drugs. And I'm saying that if you take a look at the composition of Choice's portfolio, it's foolproof. It is it's PPF. It's perfect property. You know, it is what you want to be in at these times. And coming out of it, you can take a look at the long-term intensifying and doing all those other things. But in the meantime, food stores, you know, have outperformed any other sector in the market. Drugstores. So when you own the biggest grocery chain and you own the biggest pharmaceutical chain, that's not a bad place to be putting your money at this point in time. So it's a plug, but in the end, I do differentiate that today, fortress malls are not as good as a grocery anchored shopping center.
I agree, Fred. In the short term, they're not going to perform as well. And that's why you touched on another point is, you know, you need very strong balance sheets, or you need lots of capital to withstand these fluctuations. And the people who own Yorkdale, etc., they have very deep pockets, and you know, they will be fine, because Yorkdale, whenever the post-pandemic, it will attract those high-quality tenants again, and people need that experience in those restaurants.
So I would put it to you, Rael, that when we get through this, what tenants are going to survive, and who do you backfill that great asset with?
Fred, I don't deny it's going to be challenging, and you may have to demall part of it, and you'll put condos, etc., on the parking lot. But I'm not saying it's not going to be challenging, but that's why those fortress malls are probably good long-term investments. The B malls are going to be very challenging long-term investments, because their dirt isn't good.
Yeah.
So Freddie, I was listening to these guys interviewing you on a commercial real estate podcast, and you said that the thesis at the time, it was a few years ago, was pets, drugs, and rock and roll.
Yeah.
And so I guess you're focusing on pet stores, you know, drug stores, and rock and roll was entertainment, sort of in things like Cineplex and, you know, gyms. And so you're already, I guess you're still bullish. We didn't talk about pets, but drugs and groceries you talked about. But thematically, what would you be saying today instead of pets, drugs, and rock and roll?
I would say pets, residential, and drugs. Because fundamentally, the rock and roll entertainment obviously has been hit terribly through this. But the truth is that if you're a Netflix holder or a Peloton holder, that part of the entertainment is still a part of our lives. It's just moved from the commonality, or, you know, having something that you'd have to go see, to cocooning at home. But drugs are more so than 5 years ago, because we're 5 years older, and that you know, baby boom generation is moving into convalescence soon. So the bottom line, and interesting enough, I'm doing 2 pet value deals right now. I've done more coffee, pet, and food store deals in the last year than I've done in the last 4 years. So it really, the paradigm has only changed on the entertainment. But as I said, if you're buying Peloton stock or looking at Netflix or looking at home entertainment, it'll be very interesting to see what happens to gaming and the cinema business, and how that's all going to convert, and what's going to be needed. Are they going to start convert to larger theaters, which give you a very different experience than having 16 cineplexes in the same area? Something's going to have to give there. And but they've been talking about the demise of the entertainment business since the 50s, when TV came on the side. So again, I think people still want to get outdoors. Last night I had dinner at a restaurant out in a tent. There wasn't a seat to get. If you try to eat somewhere in Yorkville right now that has a patio that's enclosed, you can't sit. So, you know, people still are social creatures, and they're tired of seeing only their families and not hugging their kids or whatever is affecting them. So.
Okay, so I'll dovetail it into this question, because I'm kind of interested in the equilibrium point. So retail's been under pressure for a while, even before COVID. And now COVID's obviously accelerated certain things. So you've got e-commerce is a big thing. And Freddie, you mentioned industrial, and Rael, I don't know if you want to comment, but I know I just saw you guys sold actually some non-core retail stuff, and you bought small, but you bought some industrial stuff. And so what's the end game for the disruption to retail? Like, where is equilibrium? Because retail won't be dead. I mean, we've talked about some of the stuff that will thrive. But what does the equilibrium look like?
I use the analogy that, let's say that before the pandemic, 12.5% of sales were done online. And I figure in midst of the pandemic, you're looking at probably maybe 42% of sales coming online. I think they're going to end up doubling from the 12.5 and being around 25% of total sales once the dust settles. And the repurposing of where that shortfall happens is going to be the most interesting. Does it become distribution center? Does it become residential? Does it become office? Does it become drop-offs? Like, I don't know how that's all going to fill out, but I definitely do not think we're going to return back to pre-COVID online sales. But I don't think we're going to be at the same place because while all the delivery systems are working and doing phenomenal right now, and by the way, destroying, this is something that needs to be observed by the governments, that the delivery systems are gouging the poor restaurants in terms of the amount of money they're taking for deliveries. And I'm not talking as a consumer, I'm talking about we need to support our restaurants. And I'm doing it because I love junk food, and my friends on this line will all know that. But the fact is that they're charging almost the same overhead as rent for deliveries to the restaurants. Not cool.
Evan, you want me to just quickly comment on industrial?
Yeah.
Look, I know, like, we own a diversified portfolio. Just for background, we have primarily retail. About just under 80% of our assets are retail, and as Fred said, it's primarily grocery anchored retail or neighborhood shopping centers. And then we own, a large portfolio, about $2 billion of industrial, and we own some office, and then we've been building some purpose-built rental. But, the way we look at our industrial is that we have a small portfolio of power centers, and we viewed the industrial as almost a hedge to those power centers, because any pressures that Fred spoke about on some of the fashion tenants or some of the demise of some of those tenants on retail, we've more than made up on rent growth in industrial, on increased demand for industrial, etc. So there will be a point in time when the likes of Amazon and some of these, large distribution companies stop growing, and then there will be pressure on industrial in the future. But right now, by far, it is the hottest asset class. It's very difficult to buy, and you just can't find land to build it, just because some of the municipalities don't want it. So it seems to be going further away. But look, our portfolio is performing very, very well, and we've been selling some retail or interest in retail to try buy more industrial when we've had the opportunity.
And so on that industrial thesis, I mean, for the smaller players who are trying to build exposure, in Toronto proper, it's extremely difficult. But would you go to secondary or tertiary markets?
So we've tried to focus on the major markets for industrial. Like, we do own Loblaw distribution facilities outside of the major markets, but really generic industrial, we've really focused on Vancouver, Calgary, Edmonton, Toronto, and Montreal, and then some in Halifax. It's just, would we go out of those major markets? We wouldn't. It's your opportunities to find alternative tenants. If you lose your tenant, it's a lot more difficult in those secondary markets on industrial.
Okay. And so one other thing just on COVID and impact, I mean, you guys are, in your pipelines, you both have significant development stuff happening. And in fact, I think you guys are neighbors in Bloor and Dundas. I think you're both developing there. And Freddie, on your website, you guys say you want to redefine categories. And Rael, I was looking at what you guys are proposing to do at Bloor and Dundas, and that looks pretty category redefining as well. So do you want to maybe just share with us the vision, both of you, for what's in the pipeline? And I mean, what I'm hearing from you, nothing necessarily is changing, because you're saying these are long-term assets, and long-term we think things will be fine. But so maybe you can just share with us, how you're redefining the categories. It really looked pretty interesting.
So Rael has the benefit of the public markets, and because of his strong balance sheet and his very, very conservative approach, he's been able to do something and, you know, raising dividends and doing things that no one else has been able to do. And that's why he's, you know, he's stuck to his game, and it's served his unit holders extremely well. I'm looking at the institutional market, and the institutional market is basically looking for long-term hold. They don't want the condo, you know, there are people that do condos. There's lots of people in that space, and that's in and out, etc., with a retail podium, and that's always a second thought or an afterthought. What we're doing in almost all of our deals now is trying to incorporate mixed use, where we have a food store, a drug store, and rental units, high-rise rental, which finally work now, because when everybody was doing their pro formas 3 years ago, everyone was trying to push to see if you could get $3 a foot. Now people are seeing $4.50 a foot in certain areas, and almost anything with a 416 starts with a 3. And that's because of the existing inventory is also being able to provide that type of numerical output. So what we're trying to do is satisfy the, you know, our partner of choice right now, not that choice, but it's Timber Creek, or actually now Hazelview. And so we're looking at everything, and in terms of transit-oriented, working the retail, and starting with retail up, which is something that very few people do, and then working to sit there and figure out, configuring what the needs are of the community in terms of, you know, affordable housing, size of units, community space, all those things that are being forced upon us. But actually, I'm not reluctant in having those things forced upon us, because it does build, we'll have a better city because of that. So.
Fred touched on all of it. Our development pipeline is really focused on two things. So one, we're doing purpose-built rental with joint venture partners, and they're generally, you know, single tower investments, where we've acquired land or taken a small portion of land, and we're building downtown in Liberty Village or Dufferin and Queen. We're doing something in Brampton on the GO train. We're doing something in Ottawa, in a very good area. But that's been the bulk of our investments. And then you spoke about the future, which is the city building all those major mixed use. And Fred touched on it. We really want to create a community. We long-term want to own purpose-built rental. But in order to have a successful community, you need all types of housing. We're going to need seniors there. We're going to need condo. We're going to need, you know, so you can't just have purpose-built rental, otherwise you're going to be competing against yourself. And you know, we have essentially, it's, you know, old grocery store sites or old retail shopping center sites that over time, the highest and best use is no longer the existing use. It will be to intensify the site. And, you know, Bloor and Dundas is just one example of the sites that we own, where over time we will, you know, intensify the site. But, you know, Fred touched on the rezoning process. It's very difficult to get zoning in place. So it takes, you know, call it 5 years to take a site through the rezoning. And we're in the fortunate position because we have income on place on the piece of land. So we're not under pressure to start construction. We will start construction when it makes, you know, the most sense to start construction.
And that, you see, that's the beauty of Rael's position in the market. They have, because I knew this when I was doing a lot of business with Loblaws in my old place, they have a huge amount of potential residential redevelopments. But unlike others, they are doing it on a very measured basis. They are not a development company nor a development REIT. And as I said, their conservative approach of, you know, everyone's looking at, because the magnitude of the Dundas and Bloor site, and the magnitude is ginormous, but they'll end up bringing in JV partners in terms of the residential. They'll end up doing what it takes to mitigate the risk, because again, unit holders care about the sanctity of their distributions, and to know that they are basically a conduit to distributing income, because that's really that's the business they're in. So the development side is much sexier, but in the case, he's taken on the best in class development partners so far, to do that part of that. So nobody just de-risks like Rael.
So Freddie, you're doing a great job on IR because I'm keeping an eye on the questions. Rael, you got to hire Freddie because my dad just sent me a text saying, should I buy some choice REIT? Dad, based on what I'm hearing on this call, probably yes. I also have a question.
Choice REIT, from my perspective, is one of the few publicly traded entities that is trading what I deem to be below NAV. What their yield right now is basically trading below what a grocery anchored shopping center would trade on the market today. Is that a fair? You can't say it, but
look, we issue financials and we do mark assets to market quarterly, and you know, the NAV does not capture everything. It doesn't capture that density potential that we spoke about, but you know, the book value of our units is called at $12, and we're trading at around 13 or 13, just over 13. So, but we think there's lots of long-term growth potential in the stock, but you have to be a long-term owner of it, not a stock. REITs aren't stocks that you generally trade.
Right. It's Warren Buffett's philosophy. Okay, so there's a question that did come in from Leslie. And shame on me for not asking it because it's a good question foremost to be asking. And if you guys are willing to share. So we're to you guys, we're a relatively small lender, $250 million portfolio, financing mostly infill residential construction. But so one of our investors asked the question, who do you recommend as borrowers for foremost to loan to? So I guess thematically, we're actually sitting on $23 million of cash right now because we haven't liked what we've been seeing out there. So if you were in our shoes and on our credit committee, as a smaller lender who had been focusing on infill construction, residential, where would you go now?
You should speak to Kevin Stark after this meeting, after this, because we're raising funds right now for equity, basically, and it's not a blind pool. It's based on a couple of sites, including Dundas and Bloor. So may as well make a pitch.
Okay.
Look, Evan, we do loan money, but we loan money to generally partners. But I think just focus on the character of the borrower and make sure that, you know, they have a history of being true to their word, a history of you know, developing good quality product, you know, and then obviously on the collateral. But we loan generally to our JV partners. We've actually, Fred's a borrower, or Trinity's a borrower, should I say.
Borrowers.
No, so that's why it's got to be nice to you.
No, you know, we actually, we speak quite often and talk about trends and talk about, you know, I'm always trying to help them place people and et cetera. There's a mutual respect in terms of very common backgrounds in terms of family and business sense, and that goes back years. And quite frankly, I would not be doing a spiel on his company if I really didn't believe that, because I do get asked many times by you know, family offices and friends that are looking to place money, and where I think the best, where there's liquidity and where there's upside and where there's management. It always goes down to one thing. What Rael said is it's about management.
Absolutely.
I say it's about quality of assets.
Well, I want to actually go there now because we're going to run out of time fairly soon. But I do want to take the opportunity when I have you guys on the call to focus in on, you know, management, which goes down to values and culture and people, which I know you guys are high quality in that. So do you want to talk about the hallmarks of the culture and values that you're trying to impart in your respective organizations?
You want me to go first? So after the merger, we've spent a lot of time on culture, and truthfully, we're actually very fortunate because by being part of the George Weston group, we leverage off many of their tools in order to help build our culture, and they have, you know, tools that, you know, that would be very hard for a small organization like ours. I say smaller people-wise, we large asset-wise, but people-wise to replicate. And really, the culture goes down to, the simplest way. It's called blue culture, and it's, a series of shared values that we try and, we try and instill in our people. But ultimately, at the end of the day, it's how do you be, call it, the simplest way to explain it, it's not passive aggressive behavior and not aggressive behavior. So how do you be engaged in the moment and just be collaborative? And how are you a nice person? It's the simplest way to put it. And I must say that all the work we did over the last 2 years really paid off when it came to March, where we had to send our employees home because our employees really rallied around, these cultural principles. And I think we may have performed better. I truly believe we did perform better because of all the work we did over the last 18 months prior to COVID.
Freddie.
There's an old saying that fish smells from the head down. And when you've got somebody with a work ethic and decency and all the other attributes that Rael has, it's pretty simple to want to perform for somebody like that and be collaborative and be a part of that organization. And I had in my old space, I was there for 19 years. I never lost a direct report. That's not necessarily the best management, to be honest with you, in terms of doing what's right for the unit holders, because in the end, you need to have change and you need to have invigoration in terms of people keeping and running as they could, because people running in their 20s don't necessarily run the same way when they're in their 50s, in all fairness. But I love mentoring young people. I love the fact that I have a bunch of young, people in their 20s here, because I was mentored by people when I was in my 20s, and that's where my real schooling started. It wasn't at U of T. It was really working in the brokerage office at the head office of Royal LePage at the time. And I think that what you have to do is you lead by example. You have to be honest, forthright, and you have to roll up your sleeves, basically. I mean, the bottom line is, if you don't do that, people are not going to sit there and go to sometimes, and when you're dealing with some tough situations right now, collecting rent is almost a battle. And you have to sit there and you have to assess and you have to make judgment calls as to where someone's gaming you and when someone's, just taking, it really has a position where they need help. It also pertains to employees too, by the way. There are people that are genuinely terrified of what's going on right now. And just because you're not, and I'm not, but you have to be sensitive to those people and make sure that you're adhering to all the, fail safes that are out there. And then there's some people that are actually saying, I'm going to take advantage of this and not work and I don't care what anyone tells you. You cannot work the same remotely as you can collaboratively in the office. I'm a firm believer that walking into somebody else's office with a mask on is still better than sitting there and doing a Zoom or any of the other methodologies out there. And maybe that's because of my age, but I know that even when going to our partners' offices, etc., we still go sit away from each other wearing masks in the boardroom, and it's way more effective at getting business done. And we've closed on, we've got under contract a couple of deals, we've closed on a couple of deals since COVID started.
So I was going to ask the question, and then I decided not to, but now I will. I spent the summer up north, not in the office, and didn't realize until we came back, when my kids came back to school and I decided to come back to the office, that I was actually almost in a funk. I just didn't know it. Like, as soon as I got back to the office, there was like this energy, there was an energy there, and kind of being able to, like you said, go across the hall and talk to my partner, bounce around ideas. And so I kind of reached the conclusion that employers are not going to want their employees to work remotely forever, it's a very philosophical thing, because you hear people talking about work from home is here to stay, and you can sell your crappy 500 square foot condo at Yonge and Eglinton and move to St. Thomas and work remotely, which maybe you could do now. I mean, do you guys have an opinion on the longevity of the work from home trend? Because it impacts everything. It impacts office, it impacts condo, both of which you own.
Rael and I had lunch in the middle of the summer having this discussion. And I said, after the September long weekend, everyone has to come back to the office. And I checked if it was compliant, and I checked, and by the way, some disgruntled employees have called the COVID inspections on us twice, and we've passed, because they don't want to come back. I will not be the type of person running an entity where it's going to be run on remote. It's just not. It's not with. I'm 63 years old. I have asthma and diabetes, and I'm sitting here, and I don't feel I'm sacrificing my life by just making sure I'm washing my hands, getting my flu shot, and I'm not. If somebody actually cannot take the pressure, doesn't want it, that's a wholly different situation. But so far, when I've called people out on saying you need to be in the office, they show up in the office, and I would not be happy if I was in both your shoes that 20% of my organization was sitting at home. I wouldn't put up with it. So I'm being honest.
Yeah, look, we chose not to force people back to the office because for our office capacity can only hit 50% on the best day, just given everyone sits in the open. No one has offices, but essentially you have to book a seat and you're allowed to come to the office, as provided you obviously pass a health screen. But I'd say for the most part, when Fred and I had lunch I think it was in the summer, in June or July, I've been coming pretty much every single day for the last 4 months. And Evan, it's what you said. I'm happier. It's what Fred said. I'm more productive, and I believe people are more productive in the office. And finally, we own real estate, and our livelihood depends on people paying us rent. And if we're not willing to use our real estate, then how do we expect our tenants to use our real estate? Now, I know, Fred, I know it's contradictory because I just said we're not forcing our employees back, but we just made a decision, and it's part of a greater George Weston decision, that we're not forcing people back to the office, but the offices are open. And I really believe that the employees who are in, generally they're more senior, or you have a pool of more junior people who really want to get by in life or get ahead. But we were doing a lot better than the 20% until the most recent, call it October second wave. We were probably at 30 or 40%, and came, come October, we actually thought we would start hitting the maximum capacity, which was 50%. But as I say, long term, I really believe that organizations will have a more flexible work environment, but there'll always be, very large, or the majority of the employees will be in the office. And we had a real-time example. We had one of our largest tech tenants who had a termination option on their lease. And, they occupy 150,000 feet. And not one of the employees has been in the office since March. And we're very close with the principals, and we thought they were going to terminate their lease. And as they were going through it, they realized that at the end of the day, even though the employees want flexibility and they're not allowing any employees back in the office in the short term, they never terminated their lease at all. And that just speaks to the long-term viability of office, that when this is all done, they will bring the employees back.
Do you not find it interesting, Rael, though, that the frontline workers at Loblaws, which is a Western company, are all working? I think it's gracious of you, but I just think, I don't know if anybody's doing a favor if you can have an environment that is safe, and I make that as a prerequisite, not to have your people working for you, working with you in the same premises.
Fred, obviously safety is first, and we've always focused on safety. But as I say, we could never even get up to 100%. Even if we tried, the maximum we could get is 50%. And at the end of the day, look, people are still working, people are still engaged. We have lots of team meetings. It's actually harder to work with someone out the office. It's more effort, and it's more effort by them to be engaged with all these team meetings, as we know, bouncing around. But as I said, we made a decision, and we'll revisit the decision early next year.
All right, so I wanted to ask another question. We'll see how much time we have, but I was going to ask you about the best advice you could give to a young person starting off today, but somebody else has actually asked in the Q&A. They've said, what were the very first real estate investments you made? And what are some of the first steps one must take when getting into real estate? So do you want to share some wisdom?
Fred, I think you're better off on this one.
Well, if the truth is, if you're a young person, the first thing you should do is buy a condo or a house. You know, start with owning your own place to live and reside. That's what I did. I decided not to take a honeymoon. I bought a condominium from one of my father's partners and made 50% on my equity after holding it for a year back in when interest rates were 22%. In terms of real estate deals, I mean, there was formidable deals that that I've done through my career, particularly at REIT, which doing a hostile takeover and being involved with that with Real Fund. The first 5 properties we bought from Ivanhoe, Cambridge, and Ottawa, which basically was the first real equity raise of any sort that we did. Buying up basically. Where Eddie was great was that all his clients owned real estate, and he basically was able to get in before any of these portfolios would take to market. So, or doing the deal with Kimco in the States was a fascinating deal, or the deals with CPP or whatever. I could write a book on how many deals that have been done, but it started with buying a condo and making money. To be honest with you, for my wife and I, and it's before we had a family.
Look, I agree. You start by buying obviously your first house, but some of the transactions I've been involved in are generally large M&A, and fascinating to have been part of. But the one transaction that stuck out the most is actually a small residential building we bought. It's actually call it 200 units. I say small, but essentially it was a mezz loan that we had a fixed option on, and the day we exercised the option, we got mortgage financing, and we actually never put in any equity. So we actually pulled all the money out. So that probably was one of the best transactions where we loaned someone money with an option to buy into the real estate.
Evan, you touched before upon the whole ethos and of the companies, etc. I think much of that. And this goes to what Rael was talking about, the Weston family, and I know very well, having them done some incredible things with my hospital at Sunnybrook and everywhere around the city. Incredible legacy. I spend an inordinate amount of my time doing charitable work. As a matter of fact, we had an incredible event on Monday, which everybody supported here, and that's so much a part of my life and psyche in terms of having my business as the leverage to be able to do work in the community, in the greater community, and that to me is extremely satisfying. And by the way, was the greatest fear I had when I left REIT was would I still have the ability to go out and do that type of work? And thank God it hasn't. The brand was big, and I've been able to do what I wanted to do, but I instill that in coming to John, who basically is given tens of millions of dollars in Ottawa to his hospital and galleries and charities, and that's a very, very big part of Trinity's morality and thought.
So now Freddie's being modest. Because I think you've raised millions and millions of dollars for charities post RioCan, and it's a whole other part of your life, which unfortunately we never even got to touch on today. I really sincerely, guys, I want to thank you because I know you have a lot going on. We have a philosophy at Foremost of starting on time and ending on time, which can sometimes be a bit abrupt, but this has been an absolute pleasure, and I really want to thank you for taking the time. I also just want to thank Ricky Dogan and Jeff Carroll and my sister/assistant who helped make this call go smoothly. And the biggest thank you to our sponsors, Equitable Bank, Ernst & Young, Bloomberg Sen, Prime Quadrant, Harvey Mandel, who is our lawyer, Evans Investment Counsel, and Josh Chait. We really appreciate the support of both this, we call this FREIS, the Foremost Real Estate Investment Summit, and Face the Future Foundation, which is a very worthy charity that not many people have heard of. And finally, thank you to everybody on this call for taking the time. We will do FREIS virtually in 2021, so we're starting to plan for that probably on a quarterly basis. At Granite Club last year was our first year. We had about 100 people. Now we're approaching 150 to 200 on these Zoom calls, and the response has been very positive, so we hope to continue it. This is part of our business development, if you want to call it that, because we believe that the best thing we can do is add value to our relationships, and we want to add value by bringing actionable intelligence that people investing in real estate can use. And so let us know if we're achieving that objective in the survey that we'll send out after this. Thank you everybody for being on this call. Be well, stay positive, and test negative.
Everybody be healthy.
Thank you very much.
Thanks, Ed.
Thank you. Thanks, Greg.
Great seeing you, Rael.